guys, and welcome to Mini Money Mastermind. I know, I haven't been posting videos for a big amount of time, but today I thought that I will give you all accountancy in one shot. Now, when we think of accountancy, we think of mere bookkeeping and recording different transactions, but that's not just it. First, we identify those transactions, then we start recording them, then we communicate them, and then different economic activities go in place. Now, accounting has a series of steps. Now, let me tell you which steps they are. Well, first is when the transaction takes place. After the transaction takes place, there is a source document. Like it can be anything, a bill, a cash memo, an invoice, or anything. And from that, source document, we create a voucher. Now, voucher tells the debit account, credit account, and other details about the transaction. Using the voucher, we create the journal. The journal shows which accounts are affected by each transaction. Then after we create a journal, we have to post everything from the journal to a ledger. Now, ledgers are main books, which signify each account. For example, if I did a cash sale, my cash and purchases account will be effective. Because my purchase account will be affected because I sold some of my goods, whereas my cash account will be affected because I got some cash in return. Now, cash and purchase account are, affected. So these will go to the cash book, which is the journal for cash transactions, and then the purchases one will go to the purchases book, which is a journal for purchase transactions. Remember, there are always 5 kinds of 5 or 6, let me remember. First, there's a cash transactions, all will be in the cash book. Then there is the purchase transactions, the sales transactions, purchase return transactions, sales return transactions, and journal proper. So there are 6 different types of journals. Now, what will journal proper be? Sometimes you get a little bit extras, like you need to buy some food from the cafeteria, so there also comes, like you hire a canteen, all that part like postage and all the remnants come in journal proper. Now, in the ledger, what happens is that there are different accounts listed, and from the journal we post different accounts transactions into the respective accounts. Now, after the ledger, what do? We create a trial balance. Trial balance is actually always equal on both the sides. Now, what do you mean by equal? Now, equal means that one side will be equal to the other side. The sums of 2 different sides, the debit and credit side, will always be equal. Trial balance actually tells the total of every balance. Like sometimes debit transaction will be there, sometimes credit transaction will be there, but when we cut off everything, what is the remainder at last? That is what a trial balance tells us. From the trial balance, we create different types of statements, financial statements, like the balance sheet, the cash flow statement, income statement. There's even the trading account, right? So these different financial statements are created from the trial balance. Now let's dig a little deeper into each of these terms. But first, let me give you a little bit of tip. Dealer, D-E-A-L-E-R. Dealer signifies debits and credits. Now you'll say, what is so much about debits and credits? You see, whenever you get, you must have known from your parents that whenever they take out some money, their account is debited. But when they put some money, their account is credited. Now, technically, if we follow the rules of accounting, in dealer, cash is an asset. It stands for the A in dealer. So, shouldn't it be on the debit side? Because DEA is on the debit side and LER is on the credit side. So what is the meaning is that in the debit side, those items increase when debited and decrease when credited. But here in the banks, opposite is happening. They are increasing when they are credited but decreasing when debited. Now I know your head must be spinning by now. So let me refresh you by a beautiful view. Isn't it so green and beautiful? Coming back to what I was talking about is that increase in debited and decrease in credited. Now see, debit and credit are two different words used to signify the plus and minus of different kinds of things in finance. Now, if we increase in debited, then that means decrease in credited, right? Because they will be opposites. Now, there's in dealer, there's DEALER, dividends. Now, write this down as well. D stands for dividends. The first E stands for expenses. A for assets. L for liabilities. The second E for equity. And R for revenue. Now, what happens is that the DEA increases when debited and decreases when credited. But why should we even think about this? Well, remember, in each transaction, one account is debited and another is credited with the same amounts. So yeah, it's quite important to know which account is debited for an increase and which account is credited for a decrease. It's not important that both will be, like, if one will be debited and other will be credited means that one increase and other decrease. No. It actually means that when you debit an account, you're just performing an action which can increase or decrease that account. For example, let's take it as an example. If I have 100 rupees and I put in a bank, now 100 rupees is cash and cash is an asset. So if I put those 100 rupees in an account, then shouldn't my account be debited instead of credited? Well, yes, but that's from our side. We are depositing this in our bank account. So according to the bank will have to pay the interest on that money. Or just, keep that money. The temptation is too great, but he will still have to refrain from taking your money, right? So whenever we deposit money for the bank, it is credited. And when we take the money, the burden is lifted off the bank, and that's why it's debited. Or it's opposite for us, okay? So now that we know about debits and credits, let me explain a few examples and their effects on different transactions. Let's say Mohan starts a business, okay? So when he starts a business, he as an owner invests some money in the business, right? There's this concept in accounting which says that the owner and the business are two separate entities. So when the owner invests money in the business, it's typically a liability for the business. It has to give interest and pay back the owner's money. So yeah, the owner invests money in the business, and that is called capital or equity. Okay, now don't think that only owners can invest in their business. Actually, others can also invest in the business, like the shareholders who invest through stock exchanges. Yes, if a company goes public, you can invest in it, okay? Only if you're above 18 years old, which I am definitely not. So anyways, going back to our, conversation, I want to also tell you that in this series of steps, the dealer is applicable to each and every step. Going back from the starting, let me give you an example of each of the steps. First, let's take an example of a transaction. Okay, it started raining as well, okay? Now, let me give you an example of a transaction, okay? Now, for example, let's say I am a businesswoman, okay? And the transaction is between my customer and me. I have set up a lemonade stall, okay? So first, for the customer, I will have to need some money to invest. So first let's say that I gave some capital. Okay. Now what happens is that I invest some capital. Right, so the transaction is me investing capital into the business and cash increasing in the business. Okay. Then after the transaction, there is a source document. Yes, the source document will be actually kind of a bill which says that I have transferred this much amount, let's say 1 lakh, to the business's capital account and cash account. Now from that source document, we create a voucher where the debit account and credit account are written. Okay. Now debit account and credit account will go to mine and the business accounts. And then after the voucher is prepared, what will we have on the journal? Yes, the journal is very important. What will happen is that in the business, in the journal, they will be written in the cash journal. Okay. So what will be written in the cash journal is that cash account is debited, whereas capital account is credited. Now both of these means that the account is increased, but both of these are debited and credited, and hence the double entry system is followed. Double entry system stands for a system where there is a debit for every credit transaction and a credit for every debit transaction. So now the double entry system is followed, fine. But when we post this to the ledger, okay, what will it have on the ledger? Well, let me tell you that in the ledger, the capital account and the cash account will be affected. Now, these are the T accounts, okay? Now, what is a T account? No, it's not the T account where we'll drink tea, No, that's not related with it. Well, T account looks like a T. On one side of the T, like on the top, it will be written the account name. Then on one side, there will be the debit transactions, other side the credit transactions. So in the ledger, every account has a huge T for the debit and credit transactions. So in the ledger, which accounts will be affected? The cash account and the capital account. Yes. Nowadays, actually, most of the ledger part is computerized. All the work is computerized, but let's take it as we're doing it on notebook. Now those T accounts, when created, the cash account will be debited, so it will be written on the left side. 1 lakh will be written on the top left side of the cash account. But for the capital T account, what will be written is that 1 lakh will be written on the top left of the capital account. Okay, so capital and cash accounts are affected. Now, how will we make a trial balance from this? Now, I'm just telling you of an example, okay? It's actually many such transactions are written. Now, let's say I did a lot of business and now my ledger account is full. Okay, so now when we see the ledger accounts are now finished, what we do is that we lock the ledger, okay? Once the ledger is locked, we cannot change it anymore. So then after we have locked the ledger, we create a trial balance where we list down all the accounts and the remaining balances. Remember, credit accounts will always have credit balances and debit accounts will always have debit balances. If there's something, either it will be a credit account will either have a credit balance or a zero balance, okay? So if a credit account is having a debit balance, I'm pretty sure it's a warning sign, okay, that you haven't done your work properly. So do your work properly, okay? So anyways, what happens is that once we post it into the trial balance, let's say in my capital account there's 10 lakh of a balance and there's 10 lakh of a balance in cash account as well. From these, we will create different financial statements like balance sheet, cash flow statement, income statement, and trading account. Okay. Now, income statement, also known as profit and loss statement, shows how much profit or loss you earned. It actually lists down your revenue. Now, actually, profit and loss account is often divided into two sections. One is the trading account and the other is the profit and loss account. The profit and loss statement is divided into trading account and profit and loss account. Now, in the profit and loss account, what happens is that indirect expenses and indirect revenue is written, while in the trading account, direct expenses and direct revenue are written. Now you'll be confused. What is this direct and indirect? In the trading account, only income mentioned is the revenue. From the sales, whichever revenue is there, it will be written on the left credit side. Okay? And then the expenses like the purchases, all other expenses related to the manufacturing, sending, shipment, everything, payment, everything related to this sale of the product, only that is written there. Okay, like the rent for the factories and the payment for the electricity used for the machinery and everything else related to the production of the goods is written in the trading account. Okay, in the trading account's debit side, there all the direct expenses are written, like purchases and other direct expenses like carriage inwards, and then on the right side in the credit place, there will be all the sales or revenue we made, okay, minus the sales return. Okay, and once we try to make it equal, we'll get the gross profit on the left. Sorry, okay, I'm getting a little confused too. We'll either get the gross profit on the left or the gross loss on the right. Then we carry down the gross profit or loss to the right side of the profit and loss account. Okay, the right or left side actually. The gross profit is gone to the right side and gross loss to the left side. Subtract indirect expenses and incomes, then we get the net profit. Okay, now, oh my gosh, it's a heavy rain. Now what we do is that once this statement is prepared, we can also create the balance sheet. Okay, now balance sheet balances the assets and liabilities. Okay, now assets and liabilities, what do these mean? Well, assets, as I told you, are all the things you own, like cash, machinery, plant and equipment. Now there's fixed assets and non-fixed assets. Fixed assets actually are bought for long-term use and you're not going to get rid of them quite soon. Whereas non-fixed assets, actually they are long-term and short-term assets too. Like fixed assets are long-term assets and non-fixed assets are short-term assets. Now non-fixed assets are often like those raw materials you purchase which you're gonna use eventually. Okay, and the fixed assets are those like who will get susceptible to wear and tear, but they will stay in your grasp for a very long time, like machinery, plant and equipment, land, factories, cash. And actually cash is a non-fixed asset, sorry. And all those things that will stay with you for a long time are fixed assets, whereas cash and other things are gonna come in the non-fixed assets. On the liability side, there's capital and liabilities. In the liabilities, there's whatever you owe to anybody. Okay. Now in liabilities are divided into liabilities and capital. Now liabilities and capital. Liabilities are things you owe to third parties, but capital is the money you owe to the owner, okay, or owners. Okay, once you make a profit, either you're going to reinvest it in new materials and the remainder, called retained earnings, is gone to capital as kind of an interest, an interest to the owners. Some of that retained earnings is returned as a form of dividend to the small shareholders, and it goes as retained earnings to the main owner. Okay, now once that's discussed, let's talk about the business. Now the business also has a cash flow statement. Cash flow from different activities like investing, financing, operating. All those activities tell the operating profit, net profit and everything else in the cash flow statement. is much of it a small summary of accounting. But if you want to delve deeper, do like this video and please click the notification bell so that whenever I release a new video like this one, this surprise episode, then you'll get to learn something new. Also, a bonus tip to remember for those who are still watching is that equity is capital. Do not get confused between the two of these because they are the exact same thing. Also, there is another synonym known as revenue and sales. In the dealer, the R stands for revenue, right? Yeah, revenue means sales, the money you earn from selling a product. And the sales or revenue comes in the top right corner in the trading account. Remember, and goodbye.